Cryptocurrencies are often seen as the wild west of investing. Some people hesitate to use the word investing at all. But now that crypto assets are approaching the size of the FTSE 100, which is a large index here in the UK, I think it's time we pay it some attention. In this video, I want to cover some of the cases for having crypto as a small allocation in your portfolio, what some of the benefits are, what some of the drawbacks are. I want to cut through some of the nonsense that you see spouted online and just give you some of the data at your fingertips so that you can make a decision. Now, as a disclaimer, I'm not a financial professional. I don't have any formal training in this, simply someone who loves numbers and loves doing a bit of research. So if you're after financial advice, then please seek out a professional who will be able to give you tailored advice to your situation. Now, it is also worth declaring that I personally do have an exposure to crypto assets in my portfolio. So take that with a pinch of salt, because there might be some bias in this video that I'm not aware of, even though I've tried to present the case from a purely numbers point of view. Now, before we dive too far into any of the numbers, I just want to clear up one misconception that a lot of people have if they're particularly new to the crypto space. And that's that crypto is not Bitcoin, but Bitcoin is a type of crypto. Now, that will sound perfectly reasonable to anyone who's really got any insight into the crypto space, and that's that crypto assets, as they're called by HMRC here in the UK, are a broad selection of tokens normally based on blockchain technology, whereas Bitcoin is just one type of crypto asset. So, for example, the second largest crypto asset is known as Ethereum, and between Bitcoin and Ethereum, they're the two largest players in the crypto asset space and make up about 70% of the value of the space. Now, in this video, I'll generally be talking about Bitcoin as a proxy, just because it's got a longer track record than most of the other cryptos, and it's also the largest. But I will just give a little bit of information about Ethereum as we go as well, but I broadly won't be talking about anything further out on the risk curve than those. Now, I'm going to frame this video from the perspective of modern portfolio theory. Now, just as a really high-level overview, modern portfolio theory is looking at how you can get the best return per unit of risk. Now, risk is usually measured as volatility here, and so that's the kind of framing that I'm going to use for this video. Now, we can plot any asset class, or any individual asset as it were, on a graph, and that graph would simply usually have the axis of return on the y-axis and the volatility on the x-axis, or risk as some people like to say. So here's roughly what that kind of graph would look like. So here you can see little dots, and those dots would represent different portfolios, and this line represents the frontier, and a particular section of that line represents the efficient frontier. Now, the efficient frontier is an area where, along that line, you get the best return for the level of risk that you're taking. And so therefore, that's where you want to be with your portfolio. Now, I've pulled a chart here that plots some of the common asset classes and some of the common things that people might invest in on a return versus risk chart, and you can see roughly where that efficient frontier might be and some of the asset classes that are sitting a bit closer to it than some of the other asset classes. Now, obviously, most people just don't invest in one particular asset class. You usually have a mixture of things in your portfolio. Even if you might not recognise it, you might have investments in your pension, which might be heavily equity based, but you might also own your own home as well, so you have exposure to property in the country or town or city that you live. Now, just so you get a bit of an idea, if we take this chart where we've got all the different asset classes plotted on our modern portfolio theory graph, we can add Bitcoin and Ethereum to that graph to see where they sit. And you'll immediately notice that they're significantly off to the right of the graph, so much higher returns, but much higher risk associated with both than any of the other real asset classes that you would traditionally look at. Now, obviously, different investors are going to favour different areas of the efficient frontier. If you're younger and you've got longer time horizons, you might be more interested in your total return and therefore be happy to take more risk, so you'll be higher up that efficient frontier line as when we looked at that modern portfolio chart. A perhaps fairly extreme example of this could be the TQQQ ETF. Now, the TQQQ ETF is a 3 times daily leveraged version of the Nasdaq 100. So in a given day, if the Nasdaq 100 goes up 1%, the TQQQ goes up 3%. The leverage resets daily, so that means that over a time period of 12 months, say the Nasdaq 100 went up 10%, the TQQQ wouldn't necessarily go up 30%, because it depends on the path that the Nasdaq takes to get there. Now, if we plot the returns of the TQQQ against QQQ, which is a ticker symbol for an ETF that tracks the Nasdaq 100, we can see that it's hugely outperformed the QQQ on an absolute return basis, with compound annual growth rates of around 45%. Now, that all sounds great, but just look at the drawdowns that you'd have to stomach. In 2022, there was an 80% drawdown in the TQQQ. So whereas in 2012 you'd started with £10,000, you'd have had over £1 million in 2021, only to see £800,000 of that wiped out across 2022. That's a lot of risk and more than most people can stomach. And that's why you need to identify where you sit on that risk-reward curve. Now, just to put that into context, over the same time period, Bitcoin has had annualized returns of around 60%, and the S&P 500 has had annualized returns of around 16%. Now, as a UK investor, those numbers are based on Great British Pound returns, so they're slightly juiced than if you're looking at them in USD terms, just because of currency fluctuations that have happened over the last decade. But it just gives you a rough idea of where everything sits in its absolute return profile. And as we saw when we plotted Bitcoin and Ethereum on our modern portfolio chart from earlier, they've both tended to have really excessive absolute returns as measured by an annualized growth rate, but they've both had significant risk. So I just want to highlight some of the risks that we talk about when we're talking about the volatility here. So you can see over that decade period when we looked at the TQQQ, there was an 80% drawdown in 2022. Well, if we look at Bitcoin's short history since 2009, so the last 15 years, we'll see that there's been 7 drawdowns in excess of 75% from its all-time high values. And if we zoom in further, we can see that 20 to 30% small corrections are pretty typical for Bitcoin. Those kind of drawdowns aren't for the faint of heart. Now, obviously, I've just been talking about asset classes as we get to this point, and now we need to start really talking about correlation and mixing those asset classes, because it's highly unlikely that you're going to want to go 100% crypto asset or 100% equities or 100% bonds. You're usually going to want to mix and match to try and get the benefits of different asset classes. Now, a typical example of this in a traditional investment portfolio would be mixing equities with bonds. So generally, over the longer term, equities have had higher returns than bonds, but as the trade-off, they've seen higher drawdowns and higher volatility than bonds have. So a common benchmark portfolio that's used is a 60-40 split, with 60% of the portfolio going to equities, and that will drive most of your capital growth, and 40% going to your bonds, which again should have a positive growth, but they have a low correlation to equities. Now, why is correlation important? Well, correlation basically can smooth out the returns of a portfolio. So correlation is usually measured on a scale of 1 to -1, with 1 being assets move in lockstep positively, and -1 being they move in completely opposite directions. And so we can see here a chart that plots the correlation between equities and bonds. Now, especially over the last 25 years, that correlation has hovered around 0, which is quite good to see. And the idea behind this is that, say the equities portion of your portfolio was in the S&P 500, let's say it dropped 2% in a given day. The idea is that your exposure to bonds may actually rise slightly that day, which cushions the drawdown that you would otherwise have had if you had a 100% equities portfolio. But what about Bitcoin? Well, if we plot the correlation of Bitcoin against bonds and equities, we can see that it's generally been fairly uncorrelated to both. Although having said that, recently, as interest rates rose, bonds, equities and Bitcoin all increased in correlation. But that was broadly an increase across most asset classes, and correlations are always going to fluctuate up and down all the time. And if we look at more recent data, we can see that Bitcoin and Ethereum have started to uncorrelate again, especially from equities. So we can see here that crypto assets tend to be lower correlated to equities and bonds, but they also have high returns and high volatility. So what kind of results could we expect if we mix that in with a 60-40 portfolio, which is traditionally seen as a good benchmark portfolio? Well, fortunately, WisdomTree have done the maths for us, and so we can just look at the results here. Now, WisdomTree looked at the 60-40 portfolio, but also looked at increasing the Bitcoin exposure in that portfolio up to a value of 10%. They've then tabulated the results for us and given us a little bit of a comparison. Now, just as a broad comparison, because it's not listed here, I know it's an index people like to benchmark against. Over the same time period, the S&P 500 had an annualized return of 12.25%, a volatility of around 17.5%, and a maximum drawdown of around 34%. So that means that a 10% allocation of Bitcoin in a 60-40 portfolio would have seen you achieve better returns with a lower volatility and lower drawdown over the last 10-year period when analysed by WisdomTree than you would have done if you just simply held 100% of your portfolio in the S&P 500. Now, those kind of results make me sit up and take notice because it shows that there might actually be something here. Now, it's all well and good the correlations being relatively low between crypto assets and other assets at the moment, but is that likely to continue? Because if we found that actually Bitcoin was heavily reliant on certain traditional economic indicators to drive its price, then there's unlikely to be much benefit from diversifying part of the portfolio into a crypto asset. Now, Coinbase, which is a large crypto exchange, has done a bit of research into this. So they've looked at some regression analysis for different potential factors and the impacts they might have on the price of digital assets. So I'm going to quickly look here at Bitcoin and Ethereum just to see what those correlations are. So if we look at Bitcoin first, some of the top drivers of Bitcoin price have tended to be, and this is analysed over the last 6 months, so it's based on relatively recent data, is the spot buying pressure from Bitcoin ETFs, the active addresses using Bitcoin, and the fees paid to use the Bitcoin network. Now I see this as generally quite positive because those are all crypto asset related factors. So for example, if we were looking at an individual company's share price, we would expect that the majority of that share price is driven by fundamental factors. So the company's earnings, growth expectations, maybe sector-wide expectations as well. And so it's good to see that we're seeing crypto-specific indicators largely driving the spot price of Bitcoin. Now you will just notice if you look at the x-axis that the coefficients are relatively low. And that indicates that there's quite a broad range of factors impacting the price, and it's not any one specific factor which is really driving the price momentum of Bitcoin. Now if we look at the repeated exercise that was done for Ethereum, we can see that the top 3 factors that impact the Ethereum price tend to be investment grade bonds, the total value on the Ethereum network, and the fees paid to use Ethereum. Now you also notice that the coefficients for that data is significantly higher than Bitcoin, suggesting that these factors have a bigger overall impact on the price of Ethereum than any one factor in Bitcoin. But again, all of those factors are fairly specific crypto related, except the top one there, which is investment grade bonds. And that might be related to the fact that you could potentially compare Ethereum as a crypto asset bond because it has a native yield to it. Now to me, because a lot of those things are crypto specific related, I think that we'll generally see low correlations for the short to medium term. Whether that changes in the longer term remains to be seen, but for now I'm fairly confident that I think it will maintain a relatively low correlation to wider asset classes. Now all of this obviously has one huge caveat, and that's the time periods we have to look at historical data for crypto assets. So Bitcoin is only 15 years old, Ethereum is only 10 years old. And the first few years of their existence were hugely volatile with massive swings in returns either way. So that means we're extrapolating out into the future based on relatively short time periods. Now every investment advisor's go-to saying seems to be that historical investment returns do not indicate future investment returns, but we obviously don't have anything else to base things on. So there is a huge risk there that because these asset classes are so young, we haven't seen really what they're going to develop into. And therefore we might be making portfolio decisions based on facts that are going to shift beneath our feet, especially over the next, say, 5 or 10 years. One notable example of this might be the Bitcoin volatility over its lifetime. So futures products were introduced for Bitcoin around 2018, and since then the volatility of Bitcoin has been significantly lower than it was pre-2018. Now again, it's really difficult to separate whether that's to do with the launch of the futures products or whether that's to do with simply Bitcoin starting to mature as more people use it. Now personally, when I looked at the data, I thought that was good enough to have a small allocation to crypto exposure. Now at the time of recording I actually have quite a large crypto exposure, but just to put some of it into context, say you went for a 5% crypto asset exposure and then one of those 75% drawdowns happened. Now depending on how quickly it happened and when your rebalancing happened in your portfolio, that might only account for say a 4% drawdown in your total portfolio value, even though the crypto asset section plunged 75%. That's not too bad and shows the benefits of diversification. But as we've also seen, there can be significant upside exposure by having a little bit of crypto asset in your portfolio. Now this has been quite a whistle-stop tour. There's way more depth that we could go into in this topic, and this has purely been looking at it from a numbers portfolio perspective. There are lots of different other perspectives that we could go into to look at crypto assets in the setting of a whole portfolio, but we don't really have time to go into that in this video. Now I'd love to hear some of your thoughts below. Do you have any exposure to crypto assets? Do you not? If yes, why? If no, why? Now if you're interested in more content like this, I have a weekly newsletter that I run where I write about all sorts of topics. I've recently just looked at the economics of Hollywood, which is obviously quite different to this, but it's just interesting topics that I think are worth diving into and make for quite interesting reads. So if that appeals to you, I'll put some links down the description where you can access that. It's all completely free, and it's as much for me to condense my thoughts, but I thought it'd be worth sharing it as a bit of a form of entertainment for you. Now I'm going to leave a video up here. Now, this is one that YouTube thinks that you'll like, so I'm not quite sure what it's going to suggest, but hopefully you'll like it. Until the next video, I'll see you then.